Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tap Omudiba, and thanks for joining me. Tonight, I'm joined by Roy Daniels, Head of Africa Trading at Rand Merchant Bank. Our favorite topic, Roy, currencies, that lovely thing that we're all able to predict perfectly, of course. Let's talk Africa's largest economy, Nigeria. What's going on there in terms of currency?
The currency remains pegged by the central bank. They've kind of taken their heads, stuck it in the sand and ignored all the global happenings and what's happening economically around the world and saying, this is where we are in our currency, we're staying here, we're not moving it at all.
Right.
I think that's probably not the best approach.
Okay.
One can understand why they want to do it. They want stability ahead of appointing a government, which has now taken far too long. I think by now we should have had a cabinet in place. Mm-hmm. There's no Minister of Finance. It's all kind of all sort of wishy-washy there.
It's really strange, right? It's taken so long.
It's not helping. It's not helping the situation. And as I say, in addition to that, ignoring the fact that the dollar is so strong, the dollar is so rampant, ignoring the fact that emerging markets are under a bit of pressure globally. This is not as I've said before on the show, it's not an Africa phenomenon. This is a global phenomenon around emerging markets. Your currency should be weakening to keep yourself competitive internationally. Right. You keep a currency pegged at 200, internationally you're not competitive on your products anymore. Yep. We look at the oil producers, the rest of the world, those currencies have slid sort of alarmingly, but kept them in the balance of payment side of things positive because the currency is now slightly weaker. Nigeria is playing what I think is a dangerous game.
And that's an important point here. On the face of it, everybody complains about weakening currencies in emerging markets and in the continent in particular, but it actually improves your competitiveness in this difficult environment.
It certainly does, and your exports are now becoming of a value that you're going to export goods, you're going to earn more local currency for your goods, but you are earning. At the end of the day, R1 buys R1 in South Africa of goods. So if you now, for your rand, you're now getting R1.20 or R1.50, you're now able to buy more goods.
Right.
And I think that helps then sort of on a growth side of things for a country. It helps us immensely in South Africa and the other countries. I mean, I don't know if you saw Zambia today we've been joking about the Zambian kwacha reaching parity with the rand. It's now slightly weaker than the rand.
Yeah.
When we think the beginning of the year where it was trading. So that's going to give them a competitive edge.
Right. Now, the question is, how long can they actually afford to keep it pegged?
They believe that they can keep it for as long as they like.
Right.
And I think when I speak to our research team back at RMB, we share the same view that you cannot sustain this. It's not sustainable. And the pressure is building all the time. You'd rather have a currency that weakens slowly than one that kind of explodes and now suddenly you have to devalue it by 15 or 20%. And I think that's the challenge that Nigeria is going to face. At some point, the currency's got to go from this 197, 198 level where they've pegged it, and suddenly it's going to be at 230 or 240. You'd be better off letting it weaken gradually and slowly up to that 240 level. So now we're going to have that big sort of move, one hit. And when it gets there, the guys then start discounting the next move. And that's the dangerous game for them again, this discounting of the moves all the time.
So I guess as a potential investor in either Nigerian equities or bonds, this is a concern in terms of when is it going to weaken?
The concern is that you don't want to invest your dollars now to buy into the local markets.
Right.
Because you've got this currency that's potentially going to weaken. So now you're waiting back. And I think people will always buy into Nigeria. People will always invest in Nigeria. I mean, Africa's largest economy. If you had an Africa portfolio, you'd have to have a certain amount of Nigeria in your portfolio.
Right.
That's a done deal.
Right.
So now everyone's holding back, waiting for the currency move because they don't want to go invest now at 197.
And you lose 20%.
And you lose 20% tomorrow when they suddenly move the currency. So everyone's holding back. I was asked once before, how much is there? Potentially there's billions waiting to come back in. And it's waiting and it's pending and it's waiting for this move to 230 or 220 or 240, some indication that we're going to let the currency weaken slightly, and that money is going to go back into those markets. The yields are looking good, the equity returns are looking good. Guys want to invest back into Nigeria, but they're waiting for this currency move.
So those investments could go across the board, both in fixed income and equities. As you said, there's been quite a bit of a pullback in terms of Nigerian equities.
No, there has been, and we've seen quite a bit of sell-off in some of the sort of blue chip stocks as well. So we're waiting. Those guys are now, I mean, they're good companies, and there's good investment opportunities there. And guys are waiting for that move. You saw today that Barclays has announced that they're going to remove Nigeria from their emerging market fund as well, following on the footsteps of the JP Morgan decision about 2 or 3 months ago.
Right.
So following on from that, Barclays has decided the same on their emerging market fund. So there'll be a bit of a sell-off on the bonds, and you're going to see a slight tick up in the yields. Now the yields are looking attractive. The currency isn't there yet.
Okay. So what does that mean for investors? Is this a wait and see time, or are the yields actually good enough at current levels that you could actually afford to take a little bit of a knock?
I think it's wait and see time. I think keep the powder in the shed, wait until you see some sort of move in the currencies. When we've looked at sort of the rest of Africa and other countries as well, we've kind of said, well, the yields aren't good, but the currency's weakened.
Right.
And so we've had this kind of playoff between all of them at the moment. So you've kind of got yields up, currency not weak enough, or currency's weakened, yields haven't ticked up enough. We're starting to see these changes in the approach in the yields. We had the 300 basis point hike in Zambia the other day, which hasn't helped them, unfortunately. The currency's still been hit quite hard. But their time will come, where the currencies now move significantly. The yields are now starting to tick up as well. And we'll see that where it gets to the point where investors are buyers. Zambia's not a big market. Kenya is the one I think that the guys are going to watch closely. Yields are ticking up slowly there. We're seeing the top end of the lending rates ticking up. It'll pull the depot rates up with it as well. Currencies are sitting at about 102, possibly look for a little bit of currency weakness, but a good short-term investment for now.
Okay, so if you were focusing anywhere, possibly Kenya over Nigeria right now?
Right now, yes.
And the rest of West Africa, anything looking particularly interesting from a currency perspective?
Ghana has been a sort of wait and see now for a long time, and I think it's gone beyond a sort of wait and see. Ghana's, we're waiting to see what would happen with the IMF, what would happen to the currency, what would happen with the governments, the local governments, where's the government going to save money, the twin deficits, the sort of, how they're going to balance their current account. So I've been waiting, we're waiting now for over a year to wait and see what happens in Ghana.
Right.
Is it a potential investment opportunity right now? At an outside chance, possibly. Speculative look at it, I would say so, but it's not, it hasn't, you don't feel as reassured as we did in Ghana probably 4 years ago when we were investing.
Right.
Investing 4 years ago, we felt safe, we felt you'd get your money back, you felt that you could go to the central bank, they would give you your dollars. Right now, everything seems a little bit tight there at the moment. There seems a bit of a squeeze on foreign currency. So you're going to go in, are you guaranteed to get back out? The key thing about investing into the markets is the ability to be able to move out quickly.
Irrespective of some losses.
Irrespective of your losses. So there'll always be a price that you can trade at to get out. And that's what makes South Africa sort of the Africa market. You can get in, you can get out.
Right.
We need that same sort of scenario building up in the other countries. Now Ghana, maybe a small speculative investment just to test the waters, see kind of where it is, where it's going. Are you able to get in, get out? I mean, the key thing is liquidity. The key thing is to show to your risk managers, at the end of the day, it's all about the risk managers, and they're the ones that monitor your portfolios. You've got to show the ability to churn your book. In other words, get in, get out, get back in if you so wish. And so you need to show that. And that's why these Eurobonds become attractive to the US investors.
Right.
Because you don't have the currency side of it.
Right.
You might have a liquidity concern around getting out of those Eurobonds, which is the same level of liquidity concern you might have with your bonds in local currency, but you don't have the currency concern.
Now, for the underlying, you touch on Eurobonds, for the underlying countries, when do we get to a point where you've taken on too much foreign denominated debt, given how much local currency is weakened?
I think that the benefit of those Eurobonds is that most of those buyers are a sort of buy and they hold to maturity kind of trade.
Right.
So if you looked at the recent Angolan bond issuance, 10-year bond, 9.5% on dollars.
Good yield.
Good yield, fantastic yield. Where else are you possibly potentially going to go to get the yield?
Yeah.
Chances of default is what you've got to measure up, and on maturity. I think any large commodity producer, the chances of default is pretty low. So when it goes to agricultural side of things, it becomes a bit more of a concern, but it's oil. People are going to use oil for the rest of their lives, regardless of where the price is. So there's always going to be some sort of foreign currency generation for the country. 9.5%, 10-year bond, buy it, stick it in your bottom drawer, leave it there. I mean, you're not going to get a better yield anywhere else. And that's kind of the approach the guys take. If you can issue a Eurobond and have $5 billion worth of subscription on a 1 billion issuance, tells you there's demand, tells you people want to buy it, tells you that they're going to reissue again.
And I guess it emphasizes that the market isn't concerned about the ability to pay back yet.
No, not at all. And because they do see currency generation. And Africa remains the growth prospect for most people. And most people look at it and say, well, in the future, we're potentially going to grow into Africa and develop further markets in Africa. And this is where the sort of demand and retail demand is likely to be built. So the future for Africa isn't a bleak one, it's a bright one. And based on that, we're going through a tough time now. Who isn't? Which, as I said to you, which emerging market isn't struggling right now? So it'll be difficult for all of us. When do we see the turnaround? I think that people are saying, Q2 next year we see it switching around a bit. We'll see Africa calming down a bit. The key thing remains, I think, around the infrastructure side of our development in Africa. The ability to move the goods. The goods are here. The commodities are in the ground. It's the ability to get it out and sell it internationally. I think that's improving all the time for us. So with that in mind, the chance of default, where we're going to grow, where we're going to go, where we're going to invest, I think Africa remains the continent for them.
Okay. We touched a little bit on Zambia with the recent, the dramatic pullback of the currency this year. Is it worthwhile now taking a closer look at Zambia from an investment perspective?
I think that if you looked at Zambia now and you said, should I invest at this stage? I would think, given these moves, we must be near the top or the bottom, whichever way you want to refer to. But we are at the low point, and given the yields, given the currency, I think potentially there's some return there. And you can invest now and you can average a little bit more into those markets. I think it's the one market that's probably undervalued to a point where it now offers good value.
Right. The pullback has been that dramatic.
Yeah.
Okay. Anywhere else in terms of the continent that you're thinking is looking quite attractive right now?
Mozambique remains a key destination for most people. I think given the amount of commodities there, given the amount of coal there, given the potential, Mozambique certainly is the one. Tanzania, gone through their elections, but it's a small economy, and not sure how that's going to develop further. Rest of East Africa, the thing with Tanzania, it falls into the sort of basket of other countries in East Africa. You got Kenya, and then the other countries in East Africa. So Uganda, Tanzania, Rwanda, Ethiopia. Ethiopia is probably a key destination, but again, we need to liberalize and open and free those markets. When those markets go into free enterprise, then I think they become more attractive to international investors. You don't want to go into a market where you're going to be controlled and dictated, but potentially those markets offer us great returns as well.
Perfect. Let's leave it there. Thanks to my guest, Roy Daniels, Head of Africa Trading at Rand Merchant Bank. That's all from Buy Africa this week. Remember to follow me on Twitter, that's @Mudiba_Tsapo, and send us your thoughts about the show using the hashtag BuyAfrica. From myself and the team,